At International Asset Management, many of our clients are Americans who are living permanently overseas for retirement. So they moved from the US and they made their money in the US, and now they've retired to places like Europe or more exotic places, Latin America, Thailand, places like that. And so how do you generate retirement income as a US expat is a question that comes up generally for really anybody who's retired, but especially different maybe a little bit for Americans abroad who need that income sometimes in local currency and so on. So first of all, let's have a look at the sources of guaranteed income, because it's nice to have guaranteed income from a financial planning perspective when you're retired. If your fixed costs, if your day-to-day running expenses are covered by guaranteed income, then you need to be less concerned by fluctuations in investment markets, for example. So sources of guaranteed income can be things like Social Security from the US, from another country if you worked in another country for a while. They can be pensions, they can be annuities. Things like that will generate a great source of guaranteed income for you. And then what about generating local income in your local currency if it's different from the US dollar, because your investments might be US dollar investments or US accounts? So their investments in real estate, for example, if you have rental real estate outside the US, can generate local income. Cash products like term deposits or interest-bearing accounts can be quite useful. And certain types of investments that you might do to, for example, qualify for a golden visa, they will also be local currency investments. You need to just be aware of PFIC considerations, passive foreign investment corps. You don't want to be investing in non-US mutual funds or exchange-traded funds, because those will create US tax reporting issues for you. But US bonds, US stocks, currency products, cash products, those are all fine. Those are all not PFICs. What about non-US investment accounts and investments? Well, first of all, non-US investment accounts are generally problematic because it's hard for a US citizen to open a non-US investment account. It's hard, but not impossible. Generally, those accounts tend to be more expensive. Sometimes you don't get the US tax reporting forms, the 1099s. But in terms of US investments, or non-US investments that is, that's relatively easy. You can even have those in a US account. Some accounts allow you to buy on non-US exchanges. Even if you can't buy, if you have to buy on the US exchanges, you can buy ETFs or what are called ADRs, which invest outside the US, and as long as they're not hedged back to the US dollar, you get the currency exposure. What about US retirement accounts? Well, so the income that comes out of US retirement accounts, first of all, when you get to a certain age 73 right now, you have to start taking income from these US retirement accounts. So you should factor that into your financial planning projections. But even if you're over age 59 and a half, you can take out an unlimited amount from your retirement accounts, penalty-free, as long as you're over that age. And so you can use these retirement accounts to generate an income. You can set it up that this income comes from dividends, but it doesn't have to come from dividends. You can just sell investments from time to time and generate income, and even set up recurring payments if you like. Just remember that there are tax consequences. This will probably be taxable income to you. And then there are also non-US investments that you can hold in US retirement accounts. And generally speaking, non-US companies pay higher dividends than US companies on average. And so, for example, if you invest in many of the blue chip European companies, they pay a pretty good rate of dividends, sometimes in the order of 5%, whereas the US, the S&P 500, the average rate might be around 2% dividends. So those kinds of investments might be useful for you as well. Then you can invest in real estate investment trusts. So real estate investment trusts are investments in real estate, but they're held within a structure that can be, for example, something like an exchange-traded fund. It's basically a fund. You still have access to those as a US person. You have access to the US ones, the ones that trade on US exchanges. Beware of the ones that trade overseas, because those could be PFICs. But again, those can give you maybe a 6% dividend yield, 7% dividend yield, and it doesn't necessarily have to be real estate. There's a company, for example, there's a company called Iron Mountain, which does data storage, or there's a company that has server farms. So it doesn't necessarily have to be real estate, but if it's structured as a real estate investment trust, essentially it gets money from some kind of loans or some kind of investments, and it sends that money out to you as the shareholder in the form of dividends. Then there are dividend-producing stocks and exchange-traded funds. I mean, some companies pay dividends in the 3, 4, 5% range. A lot of the banks pay higher dividends, a company like HSBC, for example, or many of the US banks. You have specialized exchange-traded funds that are actually focus on dividend-paying stocks, also non-US dividend-paying stocks, so that you can get that currency exposure. Preferred shares are another way to get a cash flow from your investments. So preferred shares are sort of halfway between stocks and bonds. They're called preferred shares because if the company is getting into dire straits and maybe they can't pay their regular dividend on what's called common stock, they still have to pay the dividend on these preferred shares before they pay to other shareholders. That's why they're called preferred shares. And generally preferred shares, you can get dividends. A lot of banks issue these. You can get dividends in the 5%, 6% range, whereas the common stock of a bank might pay 2%, 3%, something like that. So again, these will go up and down with the stock market, these preferred shares. There's a capital gains aspect to it, but you buy it for the dividends. And then, of course, there's bonds. Bonds generate interest if you actually invest in actual bonds. Better to hold them to maturity if you can, because that way you take out the capital gains exposure, you know what you're getting in the end, but they will generate interest on a quarterly or monthly basis for you. You can also invest in bond funds, bond exchange traded funds, and those will generate, they take the interest and they translate it into dividends for you as the shareholder. And that's also a good way to diversify the stock part of your portfolio, because bonds and bond funds generally are not correlated with the stock market. A little bit more exotic are things like business development corps. These are companies, this is like publicly traded private equity. There are also private business development corps, but I'm talking about the publicly traded ones. So you have companies that go out and they invest in maybe 2 small cap companies, startups maybe, something like that. Risky investments, but they spread the risk over maybe 200 of these companies. They make loans to these companies or they take equity positions. These companies have to pay a higher rate of interest because they're risky. That interest translates to you as the shareholder in this business development corp in the form of dividends, and you can get 6 to 10% in dividends from these kinds of investments. And then finally, there are things like royalty trusts and master limited partnerships. So these are common, for example, amongst oil companies or some kind of a company that has a revenue stream, and they want to de-risk that revenue stream for themselves, so they sell part of it to their shareholders in return for the shareholders giving money to go out and buy new oil wells or whatever it is they're investing in. I mean, the downside, if there is a downside to these, again, you can have good dividends from these, but generally these are what are called partnerships under US tax law. So you have additional tax reporting requirements, you get a K-1 form. So that's a little bit of extra work for you, but that can be another source of dividend income for you in retirement.